Tata Sons, the holding entity of the Tata Group, has repaid over 20,000 crore rupees of debt to remain an unlisted company as it plans to give up its certificate of registration to the Reserve Bank of India. This was reported by the Economic Times. The parent entity of the Tata Group, worth over $410 billion, would have been required to list its shares on the market to comply with the RBI rules if it had continued with the debt. In October 2022, the RBI's scale-based regulations classified Tata Sons as a non-banking financial company in the upper layer due to its bank borrowings. This required it to be listed by September 2025. The NBFC upper layer classification mandates that non-banks be listed within 3 years. The holding company has been in talks with the RBI since December last year to avoid mandatory listing, and the people familiar with the development said it had committed to cut its debt. RBI rules requires Tata Sons, which is a registered core investment company, to be listed by September 2025. As per the RBI, a core investment company has to meet 2 conditions. It has to have an asset size of more than 100 crore rupees. It also has to have public funds. If either of the 2 conditions fail, it cannot continue to be working as a core investment company. Tata Sons' assets are mainly its investments in its group companies like TCS, Tata Steel and Tata Motors, which are definitely worth more than 100 crore rupees. As per filings in 2023, the asset value of the company is close to 1.3 lakh crore rupees. Therefore, Tata Sons is looking to retire borrowings by becoming debt-free. As per analysts, this move will help Tata Sons sidestep RBI's mandate and not being considered as a core investment company and an upper layer NBFC, exempting it from going for an IPO. In 2017, Tata Sons had converted itself from a public listed company to a private one amid a board battle between Cyrus Mistry and Tata Trusts. Even as Tata Sons looks to avoid the IPO, its subsidiary Tata Capital Financial Services is gearing up for an IPO soon.